Hi, welcome to STANLIB's weekly economic podcast. My name is Kevin Lings and I'm the chief economist within STANLIB. The intention with these weekly podcasts is to unpack some of the key economic developments that have unfolded over the past week. And for this week, I think we need to focus firstly on the US Federal Reserve's decision to leave interest rates unchanged. It was obviously widely expected, but there were three members of the committee that dissented. They preferred an interest rate hike of 25 basis points. So I think it might be useful to unpack some of the sub-detail and look at the approach that Kevin Warsh has adopted in terms of not wanting to provide any forward guidance and some of the difficulty that he's currently creating. The second topic, I think, is to have a look at South Africa's tax revenue collection during the month of June. We got the data last week, and I must say there was an impressive improvement in corporate income tax. June is a big month for corporate tax revenue, and the number they showed was way above expectations. So it's put the overall fiscal position in good shape. It means South Africa's tax revenue collection now well ahead of budget, and it does give some policy option for National Treasury as we get deeper into the fiscal year. So I think those are two important topics to unpack. There was some other economic data out during the week that is useful to look at. US GDP growth for the second quarter. That came in at 1.5% below expectations. So I think that's useful to have a look at, although we're not going to delve into it in a huge amount of detail. In South Africa, we did obviously have the trade numbers, the growth in private sector credit. There was a range of economic data, but I think for this week, the focus has to be the Fed's decision as well as our tax revenue, partly because it's simply a good story, and I think South Africa's short of good news items. So I think a bit of a deeper look at tax revenue collection in South Africa. So let's start with the discussion on the US interest rate decision. As I mentioned, it was left unchanged. So you've got effectively a target federal funds range of 3.5% to 3.75%. Ahead of time, most people did think that interest rates would be kept on hold, but there was some nervousness, I think, in the markets that the Fed may decide to increase rates. As it turned out, the decision was 3-6 in favor of keeping rates on hold. Three people argued that rates should go up by 25 basis points, mostly because they're obviously concerned that inflation remains elevated and it needs to be brought under control, and the Fed hasn't adjusted interest rates now for quite some time. In fact, I think it's been 5 meetings in a row that the interest rate has been left unchanged by the Federal Reserve, and clearly that's starting to cause some concern. So I guess in a sense, not a surprise outcome. Also, the fact that there was no forward guidance given by the chairman. He's indicated that he's not keen on any forward guidance, and he held to that promise. So the FOMC statement really said very little about the economy, said nothing about forward guidance. And so it's up to the market to interpret what it thinks interest rates will do in the United States based on the incoming economic data. And I think all of that sounds fine, except for a key problem that has now quickly developed since Kevin Warsh has taken over as chairman. And that problem is a mismatch between his actions and his statements. So in his statement, he keeps arguing that the inflation target is 2%. And in this last decision, he emphasized that it's not a soft 2%. By that, he means that the inflation target is not 2.5 or 2.7 or 2.9, it's 2%. Now, once you keep repeating that the inflation target is 2% and that you're not going soft on achieving that inflation target, then it's only right that people start to ask you questions about what are you doing to achieve that target. Now, the specific 2%, he's referencing the PCE inflation rate, not the overall headline inflation rate. So the Fed uses PCE inflation and core PCE inflation as their reference rates, although obviously they would pay very careful attention to what's happening to overall headline inflation and core inflation. So in terms of PCE inflation, that currently sits at 3.7%. Now, that's come down from 4.1% recently, but 3.7% is quite a long way away from the 2% target. And if you look at core PCE inflation that sits at 3.3%, which is also quite a long way from the target. So here's the dilemma the Fed faces. It keeps emphasizing that it wants to achieve the 2% outcome, that there is no deviation from 2% as a point target, and that it's adamant that it will get inflation down to those levels. Currently, inflation is significantly above 2%, but what is the Fed doing in order to achieve that 2% outcome? They haven't changed interest rates for the last 5 meetings, and Kevin Warsh hasn't himself indicated any change in interest rates. So there's a legitimate question. You're talking tough, but you're not acting tough. Why are you not increasing interest rates? And that's when the difficulty arises, because if you listen to the chairman talk about why he's not increasing interest rates, it sounds unconvincing. There isn't really a clear argument that is being put forward by the US Federal Reserve to say, here is why we are not hiking rates, especially since 3 members of the committee argued that interest rates should increase. And so there is a credibility issue that is slowly developing. Now, I don't think it's a massive issue right now, but it's something that you would expect that the chairman of the Fed gets on top of quite quickly and starts to articulate exactly what the policy framework is. Obviously, what would help to ease concerns is if the Fed actually did hike interest rates. Then it would be clear that their actions and their words are one and the same, and that they're moving interest rates in order to ensure that inflation is pulled down back to 2%. You could argue that the Fed is hoping that the conflict in the Middle East is resolved and that the oil price comes down, and as the oil price comes down, that will help to ease inflation everywhere, not just in the US but around the world. The problem with that argument is that the conflict just continues on, and there doesn't appear to be a resolution that is imminent. And so in the meantime, you've got a fairly elevated oil price. You've definitely got oil price pressure in the system, and that can systematically translate into broader and broader inflation and start to embed a higher inflation rate, making it more difficult for the Fed to ultimately achieve their 2% target. So it's up to the Fed how they choose to react during the remainder of this year. There are obviously some people who are suggesting that Kevin Warsh doesn't want to increase interest rates simply because he's concerned about the negative pushback from the president of the US. And clearly that could be a political override. But I don't think that Kevin Warsh is beholden to the president. I think he's got a mandate to move into the Federal Reserve and shape it the way he thinks is appropriate. But it is clouding the discussion, and that, again, is unhelpful. So hopefully when we get to the Jackson Hole Symposium at the end of this month, there's a bit more clarity from the Fed on how it's going to approach interest rates. And I think from the Fed's perspective, they either have to demonstrate that inflation is coming down and will come down quite significantly, or they need to hike rates. And so there are quite a lot of people who are anticipating that the Fed will increase rates before the end of the year. That is not an absolute, because our expectation is during the course of next year, inflation will come down and can actually come down close to the 2% level. But if that's what the Fed is banking on, then I would argue they've got to make that a lot clearer. And they've got to indicate that their own forecasts for inflation suggest that, yes, inflation in the short term remains elevated, but they don't feel that that is going to be long-term problematic, and that over time they feel they've got the appropriate level of interest rates to get inflation down back to the 2% target. They need to fill in that gap in terms of their own thinking, their own narrative, and the longer they leave that out unanswered, the more people will question this divergence between what the Fed says and what the Fed does. The reaction in the market wasn't good to the decision, particularly in the bond market. There was a significant sell-off at the longer end of the bond yield curve. In other words, 10 years sold off, 30 years sold off. Not as much movement at the short end, but it did steepen the yield curve, and that's problematic. It makes government debt more expensive, and it makes, in particular, the cost of mortgage finance in the US a lot more expensive, and already mortgages are unaffordable. And the chairman of the Fed did say that he will endeavor to make housing more affordable. But the more the long-dated government bond moves higher, the more expensive housing becomes. So again, that's not helping him in terms of his own credibility and his own narrative. So the sooner this is resolved, the better, I think. And to me, the clearest way to resolve it is either hike rates or demonstrate that you think inflation is going to be moving down appropriately within a reasonable time period, and therefore you currently feel that you've got the most appropriate interest rate. The second topic is a look at South Africa's tax revenue collection for the month of June. We got the data from National Treasury last week, and I must say the numbers look impressive. During the month, tax revenue went up by 10.7% year on year, and if you consider that the government budgeted for tax revenue to go up by 5.8% for the year as a whole, that's an impressive performance. And most of that tax revenue boost came from corporate tax revenue. During the month, corporate tax revenue rose almost, I think it was about just short of 110 billion in 1 month. That's an impressive number. Even if you go back historically, I think there was only 1 month in history where tax revenue collection from corporates was better than that. So this is a good outcome. And during the month, corporate tax revenue increased by almost 25% year on year. Most of that coming from mining companies because of the previous performance of gold and platinum prices. And obviously, there would be therefore some concern about the tax collection from corporates when we get to December, which is the other big month for corporate tax revenue collection. But so far, it's an impressive outcome. If I then look at other areas of taxes, they've also done reasonably well, particularly personal income tax, running quite a lot ahead of budget, double-digit increase in personal income tax versus an expectation that personal income tax would be a single-digit increase in terms of their budget. So we've got key components of South Africa's tax revenue now performing exceptionally well. The one key underperformance was obviously the fuel levy. Now, the fuel levy government provided a subsidy for a couple of months in order to help consumers with the much higher fuel price, and that cost government in terms of tax revenue probably around about 14 billion rand if we look at the data we've got so far. And so that was, I guess, from the government's perspective, unfortunate. It obviously helped the consumer and business base in South Africa. But if I look at the tax revenue collection, even taking account of that fuel levy underperformance, the number's still well ahead of budget. And what that all means is that government's now nicely on track to present better numbers when they get to the October medium term and then finally get to the national budget next year. And so what government would be trying to do is to present numbers that show fiscal consolidation or fiscal discipline, a primary budget surplus, and that government would hope that helps to bring bond yields down, therefore the cost of debt down, and it helps to improve the credit rating. One of the key areas, though, that credit rating agencies have looked at is not just whether or not government revenue is holding up well or what's happening to government expenditure, but it's got a lot to do with now whether we're able to grow the economy faster. We can't expect to see a significant improvement in our credit rating until we have much better economic growth and certainly much better job creation. So I think that the fiscal discipline helps in terms of credit ratings, absolutely, but it's not just about fiscal discipline. It's also about spending the money wisely and ensuring that economic growth is able to rise certainly well above 2% on a sustainable basis. But as it stands, tax revenue looks good. The area that obviously we would be concerned about is government expenditure. Now that is running ahead of budget, and we're only 3 months into the fiscal year and already we're behind in terms of expenditure, and there are some risks in the system, right? Further increases in unemployment represents a risk in terms of social payments, and there's always the risk that government has to step in and provide additional funds to support different elements of the economy, including at some point maybe municipal finances. So there are risks to government expenditure, and as I say, they're running already a bit ahead of budget. It's not massively ahead, so we're not overly concerned. And as things stand at this stage, I think the government should be able to present a decent set of numbers in October and then February. But in order for that to occur, You hope that government stays on top of government expenditure and doesn't allow any excessive increase in key expenditure items, including salaries and social payments. And then it is hopefully able to continue to collect decent tax revenue, with the idea of trying to ensure that the economic reforms are systematically put in place, that we're able to lift infrastructure development, and that we're able to use more and more private-public partnerships. And if we can do all of that and lift the growth rate, then yes, the credit rating should be upgraded quite nicely. And it's not impossible to go back to the investment grade credit rating South Africa had. And you would say the data we producing in terms of government finance puts us on track to achieve that. But as I keep saying, we've got to lift the growth rate, not just be disciplined in terms of government finances, not just disciplined in terms of monetary policy and achieving our own inflation target, but also showing that we can implement the right policy measures that lifts economic growth more broadly and is able to result in job creation and therefore a broadening out of the tax base. That's all from me for this week. Hope it makes some sense, and we'll catch up again next week. Please remember that STANLIB Asset Management is an authorized financial services provider in terms of the FASE Act. Also, this podcast should not be construed as advice.